All right, so how's everybody doing?
Going good. How about you?
Good, thank you.
Wonderful, I'm doing well, thank you.
Yeah.
All right, so I see we have a variety of investors on here. Today we're going to be looking at different things, some forms that I want to make sure that you guys already have. We're going to be looking at a question I have on affordable housing. Edith, you might be able to answer that question for me. Crypto, and then we're going to be doing some tax return reviews. I'm on here. What I wanted to do was to look at a couple of returns based on those that we have in the group that have already completed their returns, so that we can see how different things mean, mean different things to different people. It's not a one size fits all when we're looking at tax preparation and tax planning, and all that. Before we get started, do we have a couple of volunteers? Hanwei, Edith, Olu, I know Sharon shared last year. Do you guys want to tell us a little bit about your business, what you're doing, how you got started? Do you like it? Do you hate it? And what you're focusing on?
Okay, I will talk briefly. Hi, my name's Hanwei Ding. I'm a real estate investor. So I've been doing this business for about 10 plus years, and focus mostly on rental apartments. So we have been wealth building CPA client for many years. And yeah, we are continue doing rental properties mostly in Pennsylvania. So that's pretty much what we're doing now.
Okay, and where do you currently live?
Oh yeah, me and my family live in New Jersey, which is on the west part of New Jersey, but not too far from Pennsylvania border. And our rental property mostly on the east side of Pennsylvania. So it's about 40 minutes drive from our home to the rental property. That's where we are.
Hi, this is Edith. Can you hear me?
Yeah.
Oh, okay. My focus has been in rentals as well, but we're moving to no longer do straight rentals. We're doing rent to own. That way, if we have the person developing their mindset to be a homeowner rather than just a renter. Okay, that also keeps me from having to do a lot of maintenance, because if they're the homeowner now, it's their responsibility. So that's what I'm changing to in terms of my focus. The rehabbing is tough right now. I have a couple of houses that I just can't get contractors for, and it's tough. So just plugging along.
Yeah. I have a question for Hanwei and then another one for Edith. Hanwei, how did you decide to invest in PA, even though it's not far, but why did you choose PA over New Jersey?
Yeah, that's really good question. Actually, at the time when we started, I was looking into the area to be focusing on. The main reason I choose PA versus New Jersey, where I live, couple of reasons actually. Number one is the tenant landlord law, and in New Jersey versus in Pennsylvania, they're quite different.
Yeah.
In New Jersey, if something happens to the rental and the tenant's not paying, you have to evict. It takes much longer. Usually take 2 to 3 months. But in Pennsylvania, also depending which part of Pennsylvania, typically it's much shorter. So that actually sometimes helps with your, when you're in a rental business, the tenant not paying is quite common. So that's one factor. Another factor is the property tax. That, New Jersey is kind of famous for high property tax, and it's probably one of the highest in the nation. That expenses could highly directly impact your, your number, fundamental for your business. So that was the two major reason for me.
Okay, thank you for sharing. And then Edith, do you know anything about affordable housing for vets? I had another client who was asking about it. I said, and I'll ask on the line in case anybody knew about it, about affordable housing for veterans through like a nonprofit.
That I can't help with. The veterans have a specialized area in terms of finances, but I don't know how hard the changes in the system is now with the way the Biden administration is handling it. So it's hard for me to say.
Okay.
Yeah, we have a bunch, quite a few, tenants in our senior housing. The government subsidized the senior housing. We have a tenant who is a veteran, but we haven't worked with any particular organization directly,
Okay.
to just focus on the, veteran. Not that part, but I did hear those could be really good, promising field to work on, especially for rental.
Yeah, that's what I was hearing, that, like you could set it up as a nonprofit, and then the nonprofit would partner with Department of Veteran Affairs, and then your LLC could now be the one to have the properties to now rent out, strictly to veterans, just like a Section 8 type arrangement.
I see. So that may be a good field to look into.
Yeah. All right, Olu, you want to share with us a little bit what you're doing?
Yeah. Hi everyone. My name is Olu. I've, in the last 3-4 years, I've been doing rentals. But last year and this year now, I've focused majorly on, on rehabbing and flipping. So, because I joined another mastermind group, and I'm on to my third house this year now. So I'm just focusing mostly on, renovation and flipping. So I have a crew of my own contractors that work for me directly now. So that is really keeping things moving. So I'm just focusing on, flipping right now. So that's what I'm doing.
How reliable are the contractors?
Oh, they're very reliable. We have our schedule. We have houses in the pipeline, and we have stages. Demo, and I have my crew for the electrician, the HVAC guy, and the plumber. So we have everything on schedule, and I have a lead guy who helps to manage everything, even though I still overlook everything. We have schedules. So give or take, we don't want to go past 4 months, from close to, yeah.
And have you guys been impacted by inflation?
Not really.
Yes.
Not really.
Yes.
Yeah, people have been priced out, but still, whenever we list our properties, within a week we get so many offers, and then we pick.
Well, I'm asking more on the rehab side in comparison to what you budgeted out versus how much things are costing now.
Yeah, that's
All
what
right.
I want to know, if he's having any supply chain issues.
My falls have gone up drastically. Yes, prices have gone up drastically. Yeah, probably by 15, about 15% mark up in materials.
Okay. And even with that, you're still able to return a profit.
Yes, correct.
Okay.
Mhm.
All right, good. Anyway, you had something to say?
Well, yeah, when you mentioned about inflation, and I do notice in our rental, the electricity rate and the natural gas rate has significantly increased just since like last year, and that changed our fundamental. too, when we didn't actually expect some of the electric rate was double. Like one of our building, electricity used to be like like 2,000 or 3,000 per month for the payment. Now we're seeing 4,000, 5,000 per month payment. So that's quite a significant, from our point of view. I believe that's more or less related, to all the price going up and during, inflation. So.
Mhm. All right, does anybody have any questions for Edith, for Hanwei or Olu before we move on to the next item?
No, but I can share. My name is Marlon Allers. I'm an investor also in the IT space. I work 100% from home. My wife is a licensed agent for Maryland as well as DC, and we both are now investing in real estate. This is our second year. Primarily single family homes with a focus in Section 8 in Washington, DC.
Good. And how are you guys handling the DC market? That's an arm and a leg to get a property in DC.
DC is difficult to get properties, but one of the other issues that's coming up is the Section 8 program, voucher program is meeting this week to vote to start reducing the rental amounts that legacy owners have been paying. So they're voting to cut the money so that they can get more money to bring more people into the program.
Is that going to be is that grandfather or that's
what I don't know. They're saying it's for the people who actually have properties right now, so it'd be like me, it would impact me.
Oh, wow.
Yeah. And I don't the issue is they've been talking about it for about 2 months now, but evidently I found out that the vote on it through the DC, whatever, who handles the Section 8 or voucher program, it's supposed to be either tomorrow or Thursday.
Yeah, it's tomorrow. The vote's supposed to take place on tomorrow.
Is this just for the DC area, or are you talking nationwide?
No, that's DC.
Oh, okay, I see.
Hanwei is not my problem, not my kettle of fish, right?
So they're going to be cutting back on the rents that they pay, their portion of the rent for the participants. Is that what you're saying?
No, I think it's I think what Edith is saying, how, like, let's say for a family of 5, you can get a voucher for 6,000. So she's saying they're voting to maybe take it down from 6 to 4. That's one of the things that's been sustaining the DC market, is that the vouchers have really been very lucrative.
Mm-hmm.
So they're thinking of like cutting it down from, like, let's say family of 5, instead of getting a $6,000 voucher, now you're going to get a $4,000 voucher because they want to bring in more families. But I don't know how that's going to work, because then that means that they're not going to be able to get into their houses, or they'll have to come out of pocket that difference, which I'm sure they're not trying to do.
Yeah. It changes the cash flow at the end of the day.
Yeah. So what are some options you guys are looking at for those of you that are dealing in DC? What are some ways that you're thinking that you would adjust to this?
For me, the adjustment, it's a difficult situation, because when you're paying all this money to keep your house up, and then you got, now they're talking about, reducing the amount that you're being paid. Unfortunately, the changes in the laws in DC are getting to the point. It's always been a tenant-friendly setting, but now it's just like I think a negative setting for landlords, and they're just not going to keep doing it. I think it's going to be a problem.
Yeah.
And so, I'm looking right now. I have two buildings in Baltimore County. which is looking a lot better than DC, although I can't get the rent in Baltimore that I get in DC.
Now, well, I'm wondering because they still have to look at the fair market rent, right? Like no matter how, well, I guess they'll say that it's still competitive because I know it was higher. I just don't know what the premium was.
Mm-hmm.
That they might be saying even if we cut it back, it's still going to be higher than what people were typically getting out there.
Yeah, but the licensing, all the other administrative costs that you have to go through to keep the person in the house, it may, this lowering of the money may, impact how many people continue to rent to people.
Yeah.
Because if you aren't licensed, you can't take the person to court for eviction.
Yeah.
Correct.
Isn't it the same thing with all these laws too for the short-term rentals with the Airbnbs? I don't remember what state. It was one of the states said that I think started in November, like if you're not renting for more than 4 months, you're not considered at least 4 months. You're not short-term or you can't do short-term rentals if your house is not available for at least 4 months. So all these states are also coming up with their own short-term rental rules.
Yeah, well, they're just actually, trying to get access to what you're making because, that was an open-ended process for them. So they're just they're tightening it down. The other thing is if tenants in the building are complaining, that kind of thing, it's hard to know where to do it and how long.
Yeah. All right, so what I'm gonna do is I'm gonna review a couple of returns for some of you that are on the line. The whole goal of reviewing it is so that you guys can see that everybody has like a different situation and kind of things that I'm looking out for when I'm reviewing your return. And if you have any questions, we'll answer it. And then I'll finish up with us talking about some kind of like financial type planning items before we wrap up. All right, so this return that I'm looking at is married, filing separate with about 2 dependents. So one thing to know is that the married filing separate filing status has the highest amount of taxes to pay because literally they would look at your taxes as if your spouse is making double the amount that you guys are claiming individually. There's also deductions that you're not able to claim when you're doing married filing separately. Over the years, I've come to realize that a lot of people don't know that even though your spouse may have back tax issues or may have issues with child support or, just different things going on, the solution is not always to just say, hey, I'm just going to file separately. You can file there's 2 forms that you can file. There's a injured spouse form, which that form lets the IRS know that, hey, we're filing jointly, but I don't want you holding my refund and using it to satisfy my spouse's tax past due obligations that we didn't incur, regularly. And then there's also the innocent spouse relief form. That innocent spouse is the same thing that, hey, even though together, so let's give an example. Let's say one spouse files and they're getting $1,000 refund. The other spouse files and they would have owed $5,000, but together, filing together would now bring down the liability to $2,000. The innocent spouse form says, hey, even though we're filing jointly, I don't want you to hold me responsible for my spouse's liability. I want it to be separate. So they would go back and refigure what the tax liability would have been if you guys had filed separately and then give the person with a refund that credit. So it's not going to be a situation where you are now responsible for that tax liability that you guys have filing together if you would have gotten a refund. So filing jointly gives you the benefit of being able to have the lower tax rate but you can use the innocent spouse form and the injured spouse form to be able to not have your spouse's taxes or refund attributed to you or vice versa. So that's something that we usually look at when people say they want to file separately or jointly. We do the analysis, but bottom line, know that the married filing separate is a much higher tax bracket than any other tax bracket. Okay, so I'm looking at this return here. Let me see. So we had a decrease in wages of about 18 grand, and this one was due to retirement. We have business losses of 5,000. We're gonna go look at that. Rental losses of 6, pension of 9. Okay, so coming down the pike here, this person itemized. So now another thing to keep in mind is with the itemized. So just like I said, if you were doing the married filing joints, the itemized would have been $24,000. Here, they're only getting $12,000 because it's married filing separate. And then we calculate the tax liability. Again, a lot of people with the child tax credit or the advanced child tax credit or the stimulus, if you say you didn't get it but you got it, it's going to hold up your refund, or the IRS is going to reduce the amount. Because I have a lot of people, they don't know whether they got it, they didn't get it, and they just assume, okay, if I didn't get it, but if it hit your account, the IRS has it on record. Now, what we're telling people is if the IRS shows on the form that you got it, but you really did not receive those amounts, you can file. There's a form 3915. There's a form 3911 form that you can file to let the IRS know, hey, your records show that I got this money, but I didn't. It could be an issue of identity theft, or it just got misplaced or something, and they're tracking it. I understand there's a lot of people that still haven't gotten the stimulus, and then people who shouldn't have gotten paid that got paid, and then the IRS is not necessarily going after the people for that. All right, moving on, we have a New York return here. So of course, making sure that we have the federal and state, the state and the city taxes as well. And then we have Indiana, Pennsylvania. So one thing to keep in mind is that if you have a business in another state, you have to file that state's tax return. So if you have either a property or a business, let's say in Indiana, but you're a New York resident, you're required to file an Indiana return. You're not going to pay double taxes, because what happens is that whatever you paid in Indiana, you're going to get a credit for it on your state taxes, on your New York taxes, but you still need to have that tax return filed. And then in some states, if the business has income and you have non-resident partners, so let's say you have a New York LLC, but then you have a Maryland partner part of it and you guys have income, they require you to withhold taxes and pay taxes at the partnership level, which is now going to flow through to the individual return. So just wanted you guys to be aware of that. This person had an identity protection PIN. Before, they only used to issue identity protection PINs just because of the, if you've had identity theft. But, after COVID, with a lot of people being impacted by COVID, they now changed the law that you can also get yourself a protective PIN to be able to protect yourself and be able to file. So that's something to keep in mind. I'll pause now. Any questions before we move on?
I do. So, Iber, what was the other reason you had to pay another state's tax? Other than you mentioned about business, right? Mm-hmm. I just noticed our tax return, we never had to have to pay Georgia, but most recent one, we had to pay small amount of tax, like a tiny to Georgia. We never had a business with Georgia.
It depends. I'll go look and see. Depends, because you might be thinking that you don't have anything and you do. Remember, if you're also getting K1s from other sources, those K1s.
Oh, right. Okay.
Georgia, or if you had like interest and dividend income, some of it is also traced. So there's got to be something that triggered that return, which we can look to see what it is that triggered it. But usually it could be from a K-1 that you got, or it could be from,
Okay.
sometimes
Right.
even people will get retirement and not realize that their retirement is actually being sourced to another state because they moved. Some people also get unemployment from other states. And so because of that, so in your case, I don't know if you emailed David. I think David is the one handling your return.
Yeah,
He
yeah, yeah, I
can
did, I did. I just care. So what you mentioned about K1, that makes sense. It could be one of our investment, which we didn't get directly involved. Yeah, okay, got it. Okay, thank you.
You're welcome.
Barry, I have a question too. This is Tara. Hello. I don't ever recall us filing Florida state taxes, and we've had that property for quite some time.
Yay, Tara is a winner. Can anybody tell me why we don't have to file Florida? Man, y'all taking exams? Every 5 minutes, y'all gonna go down 10 points. Can anybody tell me why Tara does not have to file her property in Florida? Why are people moving to Florida?
It's because they have no state taxes.
There you go, there you go.
Tax.
Yeah, and I'm glad you brought up that point. You know what that means? If you have a property in a state that doesn't have a filing requirement, unfortunately, you now have to pay all the taxes in your home state because you have a credit of 0 from Florida because there's no state taxes.
Mhm.
Got it. Thank you.
Any other questions before we move on? All right, so one of the things I'm also looking at, there's a return that I'm looking at here. This is the business. We had income of 2,000 and expenses of 2008. So net loss of 9,000. By the time I take out my depreciation and my amortization, I have a net loss of about 3.7. Now, this is something that's very important. What is the goal of every business?
Pay your fair amount of taxes.
Making money.
Okay. Do you guys want to check your notes before you tell me what's the goal of every business?
To make money.
To make money. To make
Exactly.
money.
The whole goal of every business is to make money. So how many of you know that when you're excited, bringing me your documents, telling me that you have losses from the business, I'm not excited, right?
Yeah.
Because even though it's going to help you tax-wise, because whatever losses you had, you're going to be able to get a deduction for it. Overall, the business lost money. And the whole goal of every business as wealth builders is to make money. So yes, we should claim all the deductions we're entitled to, but you also want to be looking at your income and expenses to make sure whether or not you need to revise your strategy with the business. You know, so let's look at an example with this return. We lost about $4,000 for the business in the year. Yes, we're getting a $4,000 deduction, but let's look at the tax rate. The tax rate is 16.69%. And another 9.36%, so 26.5. So 26.5 times 0.3853, that's almost $1,000 benefit. So if you look at it, you spent $4,000, you got $1,000 benefit, but the family, like your business, really has paid out $3,000. So don't look at it, because a lot of people, I find it hard to explain to them that when you say, oh, but I'm going to get a tax deduction for it, right? Yes, you're going to get a tax deduction, but overall, you still lost money, and that's not what we want. I mean, if we're doing it over 1 or 2 years and we lost money, I can understand, right? Because in the first couple of years, we're trying to build up and stuff. But ultimately, our goal is to be generating enough income. And then we want to make sure that we're not paying more than our fair share of taxes than we need to. Does anybody have any questions on that before we move on? All right. I'm pulling up somebody else's return. As I talk about it, you may recognize that it's your return. So in this case, I have this person who is a head of household and has 2 dependents, and their wages increased significantly during the year by almost 200,000. This is very important. What I explain to people is that the business that you're doing, you know, it's good. But when you look at your overall strategy, you have to look at whether or not majority of your income is coming from wages. If majority of your income is coming from wages or pension, you know, there's very little that you can do in terms of tax planning to bring down your liability, because it's based on what's going on at your job. You know, what kind of retirement account do they have set up? Do they have a HSA set up? Do they have an accountable plan and all that? You're really at the mercy of whatever programs that your regular job has. So while you might be looking for deductions here, my business did this and my business did that, and I want to be able to get the deduction. At the end of the day, majority of your income is coming from wages. So majority of your tax liability is going to come from that. And there's very little that you can do. But what I tell people is that, hey, if you look at how much taxes that you're having to pay because you have regular wages, our goal is to see how do we recoup that money by the other things that we're doing. So in this case, for this particular client, if I look at it, the overall tax liability that we had is $96,000 is how much that we had to pay in taxes for federal. And then we had to do another 26,000 for state. So 96,000 plus 26, about $122,000 is what we had to pay in liability. But at the end of the day, one of the things that we should be asking ourselves is, how do we recoup this 122? Are we going to recoup it by the equity that we're building up in the rentals? Are we going to recoup it through the rehab income? Are we recouping it through the realtor income, or even investments that we have in the stock market? Am I putting aside enough money into the retirement account that's going to help me later on down the road? So you want to make sure that if you have a regular job, that the way that you plan for it is not going to be the same way that you're planning, like for your business income and all that. Make sure that you're looking at other aspects as well. Any questions?
Just to clarify it, I'm sorry. So you're saying if you have that much of a tax liability, it's better to look, you're saying like maybe look for, I don't understand how you're saying it. Like if you're making enough money in your side business, that would pay for that tax liability. That's what you're saying, or?
Yes, because in that case, your tax benefit or your tax reduction strategy may not be the typical ones that we're able to implement. You know, like paying you a salary from the business, splitting out your income, contributing to a retirement plan, looking at maybe some advanced tax strategies. Those strategies really work well when people have income and business income. But if majority of your income is coming from W-2, we're not able to implement that because there's nothing that we can do to bring down the wages that you earn. Therefore, your wealth building strategy may be low on tax reduction, but it needs to be high on investments that will be able to surpass your tax liability. So as long as you're building wealth, it doesn't matter whether you lose money in taxes or you make investments that generate you 122. At the end of the day, if you're able to generate investments that get you 122, if you look at it relatively speaking, you may have lost money in taxes because most of it came from your wages, but if you're making it up from the return that you have on your investments, you're still building wealth overall.
Understood. Thank you.
Okay, another thing, I see some expenses here for total miles driven. You know, this person had 8,000 miles, $4,000 deduction. Make sure that you guys are keeping track of your miles on Mile. You know, there's apps like Mile IQ. We also have a real estate activity log that we make available, especially for those of you that are in real estate, so that you're tracking your mileage expenses based on the real estate activity. Because if you do get audited, they're going to be looking at those mileage to make sure that you're able to substantiate the number of miles that you drove for the business.
Is that only if you claim to be a realtor as a full-time job that you
No.
can claim?
You can claim miles as long as it's business, as long as it's ordinary and necessary.
Got it. Thank you.
And so rental reconciliation, so it's just to understand that with this person, they had rental losses. The reason why they're not able to claim rental losses is because they made over $150,000 for the year. So the rule is that if you make over $150,000, there are two requirements for you to claim rental losses. One, that you spend at least 750 hours in real estate, which is about 14 hours a week in real estate, and not or more time in real estate than in any other active profession. So if you have a regular job where you're working, average 40 hours a week, which is 2080 hours, you need to be putting in more than 2080 hours to be able to claim those expenses. Now, what has happened is we have some clients who are able to meet that real estate professional requirement because they are putting in more time at their job, in their real estate business than at their job, because they're not really working the 40 hours. But you know what the IRS is doing now? They're actually now writing to the employers and asking them to certify that the taxpayer is not working up to 40 hours. So you want to be very careful about that, because now what they're doing is they're getting people in trouble, because now the employer is going to be like, oh, I didn't know they were working 24 hours a week when I'm paying them for 40 hours. So sometimes it's a catch-22, where if the IRS audits you and they want you to justify that you are a real estate professional, sometimes you may just have to bite the bullet and pay that tax liability, because if they go and start poking and asking questions of your employer, when you know that you're not working up to 40 hours, what is it? My former boss said, I'm paying you to be available, not to do work. So sometimes they're paying for your availability. So in times when there's no work for you to do and you're using it to build their business, they're saying that, they're going to find out from the employer whether or not you're working less than the 40 hours a week. So yes, you may be able to justify that you're working less than 40 hours, but you could risk losing your job. So that's something to be careful about in terms of how you're claiming the expenses for the rental. And remember, this real estate professional thing really only applies if you have rental property. It's not for regular income. It's not for rehab income. It's not for realtor income. It's not if you're doing notes or anything. It's really just for rental properties.
You said there were two ways that you can claim. One is if a real estate professional, that you could do those rental losses. And what was the second? If you're greater than 150, what was the second way?
No, I said two requirements. It's not one of, both. You have to meet both, which is you have to work at least 750 hours a year, which is about 14 hours a week, and more time in real estate than in any other active profession.
Got it.
Mhm. All right, so let me review one more return. Does anybody have any general tax question while I pull up just another return?
And just to clarify, so if you make over 150,000 and we do have rental losses, unless you meet those two requirements, you cannot claim those rental losses. Did I understand correctly?
Yes,
Okay.
they're suspended until, they're suspended until you either come under that limit, come under the 150, or you meet the requirements, or you sell the property. So if you never meet those requirements, when you do sell the property, all those rental losses will be claimed. And I'm glad you brought me back to it, because it also means that if you make over $150,000 and you have rentals, it also means that you necessarily should not also just be investing in rentals just because of the tax benefits that you think you're going to get from it. Because if you're not able to get that benefit and you did not factor in that there's no tax benefit, you really should be looking at the equity of the cash flow and what's going on in the area and being able to improve the value of the property. If you're only going to be looking at just the tax benefits, it's not really helping you that much.
Makes sense. Thank you.
All right, so I'm going to look at one last tax return here. Oh, so this person here has several K1s. So one of the things to keep in mind is that when you have several K1s, if you are a limited partner in a partnership and you get a K1, all those losses, same thing, they're suspended until you have passive income. So passive losses, where you are a limited member in a partnership, you're also not able to deduct. Okay, so it's only when you have passive income that you're able to use that. Okay, here I see there was a note on this person's notepad. Whenever we do year-end tax planning, I speak to you guys throughout the year. I will write some things down. In this case, I wrote here, add to the notepad that we need to do cost segregation when we do the tax return. Now, let me tell you the reason why we don't do cost segregation up front. Cost segregation is something that you can do at any time. It does not have to be done at the beginning of the purchase of the property. And also you need to make sure that it makes sense, like it's going to benefit you. Like the example I just gave, if you make over 150 and you already have business losses, cost segregation is not going to do anything for you. It just increases losses that you're not able to claim. So what we do is we first of all prepare your whole return, see how things are looking. If you have a liability and then maybe you have rental income and we're able to use the cost segregation to bring down your liability, then yes, by all means, we will do a desktop cost segregation analysis and enable you to claim some of the items as like furniture, fixture, and equipment. But a lot of people will email us and be like, hey, Barry, you know, as always, I went to this webinar or I went to this program or I was at this conference and they told us about cost segregation and I want to implement that. Okay, first of all, you can only do it when you have a rental. Two, even if you have a rental, it's not a one size fits all. There might be reasons why you don't need to be doing cost segregation. Also, if we have where you have, you know, the following year where it looks like you're getting more income in that year, it might make sense not to do the cost segregation this year. It makes sense to wait and then do it next year. So those are all the things that we look at. We don't just up and say we're just going to do cost segregation. You know, you charge all this money for it and then it ends up not benefiting you. Okay. Before I close that out, does everybody know what cost segregation is and what it does for a landlord on their tax returns?
It's adding more for the depreciation.
Okay, but adding more by what? What exactly do you need to do
So
you're able to
typically
add more depreciation?
Without you doing, I mean, I don't fully understand, even though we hire people doing cost segregation. And my impression was that they counted the other item. Normally you don't, you know, like the structure of the building, but they also added like the stuff you had inside your building. I don't know, I don't actually didn't know the detail. I just know they told me they are going to your building. They go through your floor by floor and they look at your boiler. They look the, you know, all sorts of items, and then they're gonna write up something, and then they produce this huge document, which is we send it to you. But anyway, so.
Yeah, so cost segregation is really what it means. Cost segregation. You're segregating the cost of your property. Because when you purchase the property, you're only purchasing it for one amount. Hey, this 5-bedroom, 2-bath, you know, I bought it for like what, 500,000. And so because you bought it for 500,000, on the HUD one is only gonna have the 500,000. However, when you bought that property for 500,000, a lot of things went into it. There's land, which is non-depreciable. There's personal property, and there's real property. Personal property is any item that you can physically move out of the building and not cause a structural damage to the property. Those kinds of deductions, those kind of items from the rentals, you are able to depreciate over a faster life. The regular depreciation is 27.5 years. But for those components, those items that are personal property that you can physically move out and not cause a structural damage, you're able to depreciate them over like 7 years or 5 years. So cost segregation is really looking at that 500,000, and we say, well, maybe 25% to land. So that's what, 125,000. Or maybe this other 50,000 here can be allocated to furniture, fixtures, and equipment, the boiler, the windows, the fridge, the stainless steel, the countertop, different items that you're able to move and not cause a structural damage to the property. You're able to depreciate those faster than the 27.5 years. So that enables you to get more depreciation up front. You're not going to be able to get it, later on down the road because you've taken it up front. But for some people, that's a good tax planning strategy. All right, so those are about the 3 returns that I reviewed, and I, came up with some things. I hope you guys have good information. The last thing that I want to cover for today, unless you guys have any questions for me, is does everybody have a signed and prepared advanced healthcare directive?
What is that?
Does anybody know what an advanced healthcare directive is?
Was that part of the estate planning?
Yes.
Oh,
Yeah,
okay.
Correct.
I have one, but I haven't signed it.
Okay. So at least we're making progress. I'm gonna give you what, 5% on that? No, I'm kidding. Because what good is the document if it's not signed? So what is, Edith, can you tell us what an advanced healthcare directive is?
It's basically to explain to whoever your significant other, whether it's a spouse or a child or a grandchild, to know what your rules are in terms of how you want to be managed if you get into a health situation that you can't make your own decisions. So that's the goal. So if you, like say, if I'm hospitalized or I'm in hospice, it gives your family member or your friend the control that they need to make the decisions for you, and not the state or the hospital itself.
Yeah, so it's very important that you have that. Then there's also the financial power of attorney. Does everybody have a financial power of attorney?
Yeah.
Yeah, I think that was a part of the estate planning we went through with our attorney, and they bring this whole package of stuff.
Okay, so you want to review it. You want to review it to make sure you know what is in it and where it is, and to make sure that, between the spouses, the kids, the other family members, friends, that they know where to get access to it if need be. And what I advise people is also to make sure that you have scanned copies of the signed document, and you want a physical copy that you print out and put in a binder, and then you have a scanned copy that is saved somewhere that you can send them and they have it saved, so that at any point, if you ever need to use it, they're able to refer back to it.
And I would like to suggest, if you are using any Apple products or anything where you have to put in IDs, make sure they're written down somewhere. Because my ex-husband died and we had a brand new phone that we couldn't prove that my daughter bought. And because we don't know the Apple ID, we can't get into the phone. So if there's anything else, computers, other, electronic devices that require your, make sure you let somebody know what that number or that letter or whatever that document needs to have to be able to get into it.
I know for those of you that have been with me for a while, we do this every 2-3 years. We will send out the sample family records organizer Kiplinger used to sell it. I know they don't carry it anymore, but the Family Records Organizer helps you to organize all of your important documents. You know, like all of your insurance information, the deeds to all the properties, your financial power of attorney, your healthcare directives, all of the, you know, the car deeds, car notes, bank accounts, investments, who owe you money that they need to go after, you know, and like Edith said, passwords, account passwords, login, and all that stuff. It's, you know, it's better to do it gradually now, even if you say my goal is going to be to get 2 items done a year. But depending, if you're over 60, I definitely would think that you should have it ready. But if you're in your 40s, you still have time, but not really. But yeah, you know, just say, okay, maybe this year I'm going to all my insurance documents, car insurance, health insurance, life insurance, all the insurance policies that, first of all, they're all in one place. They're all scanned and printed out and in the Family Records Organizer. The next thing you do, all the deeds to your properties, then even tax returns, then all the bank accounts, investment accounts, contact information, who are the critical people that they need to call, you know, if anything happens. Also having that as well. All right, that's it on my end. I'll take any open questions until we're ready to go.
Just one more thing on a DNR, make sure you do have that available, because if you don't and you call, you know, the 311 number and they send the paramedics, they by law in Maryland have to try to resuscitate you even if you've been gone several hours. So just make sure that's
what's
written.
a DNR you mentioned?
Do not resuscitate.
Thank you.
Thank you, Edith. Helpful information.
So I saw today, I actually, this is the first time I joined the group session. I saw the, on the email I received, the mention about some solar panel credit with Ryan. What it was, is that will be in a different session? We'll cover that?
Yes, because I travel. I'm sorry, I was having way too much fun. I forgot to ask Ryan if he could be on the call. So he just sent me the information today and I haven't had a chance to review it. So I want to review it, and I also want him to be available next week on the call, so that while I'm reviewing it, he can at least answer questions. So we'll deal with that next week along with the rest of the financial plan and stuff.
Okay, wonderful. Okay, I will be looking forward to that. Thank you.
No worries.
I too joined for the first time this week. Do you have the recordings available, or you're not like?
Yes,
shared?
I have all the recordings available. When we send you out the messages on Friday, I did it this Friday because I was on air in Mexico and I forgot to schedule it before, but each meeting announcement that I send out, I'll send out the past group session recording. So this is the 3rd one. So by Friday, you're going to get all 3. It'll say, you know, group session 1, group session 2, group session 3. And these are the topics that we covered. So you have a chance to go listen to all of them.
Thank you.
Wonderful. Wonderful. Thank you.
That's good. Thank you.
All right. So in the absence of any other thing, thank you guys for joining. And remember, if you still want to do your one-on-one, you want to fill out the link that Barola sent to you, or you can call the office to schedule your one-on-one annual business meeting appointment.
Okay,
Thank you so much.
Chair.
All right.
Thank you.
Bye, everybody.
Thanks. Bye-bye.
Thank you, everyone.